All right, buckle up, everyone, because today we're diving headfirst into the world of Lenfi.
Lenfi.
Yeah, Lenfi. It's this decentralized lending and borrowing platform built on Cardano.
Oh, Cardano. Interesting.
And, you guys have sent in a ton of questions about it.
Yeah. A lot of people are curious about this one.
So we're going deep on this one using their light paper and some additional insights that we were able to
Some
find.
extra intel.
Yeah, to really try and understand how this thing ticks, what makes it stand out from the crowd, and ultimately whether it's something worth your time.
It's really interesting to me about Lenfi is that it's not just another DeFi platform trying to jump on the bandwagon.
Right.
It seems like they're really trying to solve some of those big challenges that have been, kind of holding back DeFi from really going mainstream.
Okay, like what? What kind of challenges?
Well, we're talking about, like the speed of transactions, the costs involved, even just the complexity of using these platforms. For a lot of people, it's just too much.
Too much of a headache.
Yeah, exactly.
So you're saying Lenfi is aiming to make it more user-friendly, more efficient.
That seems to be the goal, yeah.
Okay, well, I'm seeing here that they're built using Cardano's EUTXO model and that Aiken smart contract language.
Right.
So for those of us who might not be super techy, what advantage does that give them over, say, Ethereum-based DeFi platforms?
That's a really good question, and those are actually two key pillars of Lenfi's approach.
Okay.
Some of these DeFi platforms, especially those on Ethereum, they kind of get bogged down when things get really busy.
Oh, yeah, for sure. Transactions get super slow and expensive.
Exactly, and that's a major turnoff for a lot of people.
Yeah.
So what Cardano's EUTXO model does is it's designed to handle a way, way higher volume of transactions, like all happening at the same time.
So it's more scalable.
Much more scalable.
Yeah.
And then Aiken comes in because it helps keep those transactions lightweight, less data heavy.
Okay, so less congestion, faster transactions, lower fees.
Exactly. It's all about that efficiency.
Got it. But let's get down to the nuts and bolts here. How does lending and borrowing actually work on Lenfi?
Okay, so Lenfi offers two main avenues for that. Peer-to-peer lending, where you're basically connecting directly with another user.
Okay.
And then there's liquidity pools, which are kind of like, these big pots of crypto assets that anyone can contribute to or borrow from.
Right. I mean, that seems pretty standard for DeFi, right?
Right.
What's different about Lenfi's approach?
Well, like with a lot of things, it's all about the details.
Uh-huh.
So with their peer-to-peer lending, you can actually set very specific loan terms. Like, you choose the interest rate, the duration of the loan, even the type of collateral you want.
Really? Okay, so it's more tailored.
Yeah, it's like a highly customizable loan marketplace, if you will.
Interesting. So you can really cater it to your specific needs and risk tolerance, I guess?
Exactly. Exactly.
Okay, but what about those liquidity pools? I mean, we see a lot of platforms using those. What makes Lenfi stand out?
So Lenfi's pools are interesting because they've baked in some really unique risk management features.
Okay, tell me more about that.
For instance, they use dynamic collateral requirements. So like if the market starts to go haywire and the value of your collateral drops suddenly, the platform might ask you to add more to keep your loan healthy, protect the lender.
So it's like a safeguard against those wild market swings we see all the time in crypto.
Yeah, exactly. It's all about creating a more stable, predictable environment for lending and borrowing.
Makes sense. And then, of course, there's the whole question of interest rates, right? DeFi interest rates are always in flux. What's Lenfi's approach to that?
They actually use a system where rates adjust dynamically based on supply and demand.
Okay, that's pretty common.
Yeah, it's pretty common. But here's the catch. Once you lock in a loan, that interest rate stays fixed for the entire loan duration.
Oh, really? So no surprises.
No surprises, no sudden spikes in your interest payments. I mean, that's got to be pretty appealing for borrowers, especially in a market as volatile as crypto.
Yeah, peace of mind is definitely valuable.
Absolutely.
But I'm curious, how do they even calculate those rates? Seems like there's a lot that goes into it.
You're right. There's a whole formula based on like the base interest rate, the optimal utilization rate, and then these two different slopes that determine how quickly the rate changes.
Okay, you lost me at slopes, but I get the idea.
Yeah, it gets pretty into the weeds, but the whole system is basically designed to make sure there's a healthy balance between lending and borrowing.
Right, right. So I don't want to bore our listener with all the math, but is there like an analogy you could give us to kind of help understand how these rates adjust?
Sure. Imagine like a ride-sharing service during a big event, right?
Okay, I'm with you.
So demand is surging, there aren't enough drivers, prices go up to try and encourage more drivers to hit the road, right?
Yeah, classic surge pricing.
Exactly. So in Lenfi, If the demand for loans in a specific pool increases, the interest rate climbs, basically incentivizing more users to deposit their assets and kind of become drivers in that pool.
Oh, I see. So it's like the higher the demand for loans, the more attractive it becomes to lend your crypto.
Exactly. And then, on the flip side, if demand is low, rates gradually decline to entice borrowers with better deals.
Okay, that's actually a really helpful way to visualize it. So it's all about finding that equilibrium.
Precisely, finding that sweet spot where both lenders and borrowers feel like they're getting a fair deal.
All right, I'm with you. But, you know, to make sure everyone stays on the right side of that balance, Lenfi introduces this thing called the health factor, right?
Yeah, yes, the health factor is a pretty important concept in Lenfi.
Yeah, we saw that term come up a lot in the documentation. So tell us, break it down for us. What is this health factor all about?
Okay, so think of it like this. It's a measure of your loan safety margin.
Okay.
It takes into account your collateral, the amount you've borrowed, any interest that's accrued, and then the liquidation threshold for that specific asset you've used.
So it's like a snapshot of your loan's overall health.
Exactly. A higher health factor means you're in good shape, plenty of breathing room. But if it starts to dip too low, that's when you might run into trouble.
Trouble meaning.
Well, meaning your loan could be at risk of liquidation.
Ah, liquidation, the dreaded L word.
Yeah, nobody wants to go there, so a healthy health factor is definitely something to keep an eye on.
So the higher the better, basically. But what happens if it dips too low? What are those liquidation thresholds all about?
So Lenfi, they accept various crypto assets as collateral, right?
Yeah.
You've got ADA, their own LNFI token, stablecoins like DJED and others.
Right.
Each of those has a specific liquidation threshold, which is basically the point where your collateral is no longer enough to cover your loan.
Okay, so if the value of my collateral drops below that threshold, boom, my loan's liquidated to protect the lender.
Exactly. And what's really interesting is that Lenfi doesn't use a fixed liquidation threshold for each asset. They adjust it dynamically based on market conditions.
Dynamic liquidation thresholds. That's pretty unique. I haven't heard of that before. So how does that impact things?
Well, it allows them to be more responsive to market volatility, right? If the price of, say, ADA is just in free fall, they can raise the liquidation threshold to protect lenders from taking on too much risk.
So it's another layer of protection built into the system. This all sounds really good for the lenders, but what about the borrowers? How are they protected from getting unfairly liquidated, if the market takes a sudden dip?
Well, that's where the health factor comes into play again, right? It acts as an early warning system. So as your health factor starts to decline, you'll actually receive notifications, giving you time to add more collateral or maybe repay some of your loan to avoid getting liquidated.
Okay, so it's not just about like punishing borrowers, it's about giving them the tools and information they need to kind of manage their loans responsibly.
Exactly. It's about creating a system that benefits both sides, that's fair and transparent.
That's an interesting approach, particularly in the, kind of the wild west of DeFi as it sometimes feels.
Yeah, definitely.
But before we move on, I do want to touch on the fees involved because transparency is key in DeFi, right? So what kind of fees can users expect on Lenfi?
They've actually got a pretty straightforward fee structure.
Okay, lay it on us.
There's a fixed pool fee for, deposits and withdrawals. Then there's a protocol fee, which is based on the interest paid, a liquidation fee if, that unfortunate event happens, and then a small swap fee if you want to exchange assets within the platform.
Okay, that seems pretty standard, I guess. But I'm seeing here that the protocol fee actually changes based on the platform's utilization rate. Can you unpack that a little bit?
Sure. So basically, when the platform is being heavily used and utilization is high, that protocol fee goes up slightly.
Why is that?
Well, it's a way to incentivize users to provide more liquidity to the system when demand is high, right? It kind of keeps things balanced.
Okay, so it's another mechanism to maintain that equilibrium we were talking about earlier, ensure there's enough liquidity to meet demand.
Exactly. It's all about creating that sustainable and kind of self-regulating ecosystem.
All right, I'm starting to get a sense of the mechanics of Lenfi. It's clearly a very thought-out approach to lending and borrowing, a lot of emphasis on risk management, transparency, and, making it user-friendly.
Yeah, I'd agree with that.
But we've only scratched the surface here. And I'm particularly intrigued by Lenfi's use of NFT bonds, which seems to be one of their, most unique features. Let's delve into that next. What exactly are these NFT bonds and how do they fit into the whole picture?
Now, that's where things get really interesting.
I can't wait. Okay, so NFT bonds, this is where things get really interesting with Lenfi.
Yeah, they're not just kind of slapping NFTs onto a DeFi platform for hype, you know.
Right, right.
They're actually using them to represent actual loan agreements. Like it's a whole new level.
So how does that work? Can you break it down for us?
Sure. So basically, when a loan is created on Lenfi, two NFT bonds are generated, one for the borrower, one for the lender. Think of them like, digital IOUs.
IOUs, okay, but we're used to IOUs being just pieces of paper, right? What's so special about these NFT
Well,
versions?
the key difference here is that they're tradable. You can buy, sell, even transfer these NFT bonds on jpg.store. It's a Cardano NFT marketplace.
Wait, so you're telling me I could potentially buy someone else's loan agreement? Why would I want to do that?
That's a great question, and that's kind of where things get really interesting. Let's say you think a particular asset that's being used as collateral, you think it's undervalued.
Okay.
You could buy the borrower's NFT bond at a discount, essentially taking over their loan.
Oh, I see.
And then if the asset price recovers, you could repay the loan and pocket the difference, make a profit.
So it's like a secondary market for debt
Yeah, exactly.
where people can speculate on the future value of the collateral.
Yeah, it adds a whole new layer of complexity and potential opportunity, but of course,
Risk.
also risk, right? What if the borrower defaults on the loan?
Yeah, that's what I was just thinking. What happens then?
Well, that's always a possibility, but Lenfi's system is designed to try and mitigate that risk. So if a borrower defaults, the lender or whoever currently holds that borrower's NFT bond,
Right.
they can initiate the liquidation process.
Oh, okay. So there's still a safety net there, but I'm trying to wrap my head around how this all works with the different types of lending on Lenfi, right? We talked about peer-to-peer lending and liquidity pools. Are NFT bonds used in both?
They are. They're
Ah.
integral to both of those models. In peer-to-peer lending, they provide that extra level of customization and tradability we were talking about.
Right.
And in liquidity pools, they represent your share of the pool,
Oh, okay.
essentially acting as proof of ownership.
So no matter how you choose to lend or borrow on Lenfi, those NFT bonds are kind of underpinning the whole system.
Yeah, it's like a universal language for debt agreements on the platform.
Okay, that's a really cool way to think about it. But I'm curious about the implications of all this for Lenfi's governance. We talked earlier about how the LNFI token gives users voting rights, but how does that actually translate into decision making?
So it's a two-phase process.
Okay.
First, proposals, they're discussed and debated on the Lenfi community forum.
Right.
And then if a proposal gains enough support there, it moves to an on-chain vote where, LNFI holders actually get to have their say.
So it's a combination of off-chain discussion and on-chain voting.
Exactly.
Pretty standard for DAOs. But it seems like Lenfi is aiming for something more, right? They mentioned this whole idea of moving towards a fully autonomous DAO.
Right.
What would that even look like?
Well, imagine a system that's self-governing,
Yeah.
where all the rules are encoded into smart contracts
Oh.
and the community's decisions are executed automatically. It's like a decentralized hive mind making decisions about the platform's future.
Hive mind that sounds both like futuristic and potentially chaotic.
It definitely has that potential.
Well, wouldn't that require a really high level of trust in the code and the community's decision making?
Absolutely. And that's why Lenfi is taking a very gradual approach.
Yeah.
They're starting with a more human-driven governance model
Hmm.
and then slowly introducing more automation as the community gains experience and confidence.
So it's about finding that balance.
Yeah, finding that balance between, community involvement and automated decision-making.
Right, but how do they ensure that the community is, actually making informed decisions? I mean, DeFi is complex. How do they keep everyone on the same page?
Transparency is key here.
Okay.
They're really committed to open communication. They regularly publish updates, blog posts, even technical documentation to explain their decisions and the thinking behind them.
So they're trying to educate the community, basically.
Yeah, foster a culture of informed decision-making.
Okay. Makes sense. But let's be honest, DeFi isn't all about, community and governance. It's also about security.
Right.
I mean, we see hacks and exploits happening all the time. How does Lenfi address this very real concern?
Yeah, I mean, security is paramount for any DeFi platform, and Lenfi takes it very, very seriously. They've implemented multiple layers of protection, starting with their choice of Cardano as their base.
Okay, so building on Cardano's already strong security is a good start, but what else do they do?
Well, they've also gone through multiple smart contract audits,
Right. That's correct.
conducted by reputable firms. So these auditors, they essentially scrutinize the code. They're looking for any vulnerabilities that could be exploited.
So it's like a security check, a double check.
Exactly. Bringing in those external experts.
Right. That's reassuring. But what about, once the platform's live? How do they protect against ongoing threats?
So they have a bug bounty program,
A bug bounty project.
which incentivizes ethical hackers, the good guys,
The white hats.
yeah, to find and report vulnerabilities. It's like a continuous security audit where they're actually rewarding people for finding those weaknesses before the bad guys can exploit them.
That's a really smart approach. It's like having like an army of security researchers on your side.
Exactly. But I know you're thinking, what about those kill switches?
Yeah, exactly. Do they have one of those?
They've actually stated very clearly that they don't. They believe that a kill switch, while potentially useful in an emergency, it introduces a point of centralization that goes against the whole ethos of DeFi.
Right, so it's a trade-off.
Yeah.
They're prioritizing decentralization over the ability to shut things down quickly if things go south.
Yeah, exactly. They're putting their faith in the code and the community.
But doesn't that create more risk though? How do they mitigate that?
By focusing on those preventative measures, those audits, the bug bounty program, they're trying to build a system that's inherently secure from the ground up.
So it's about minimizing the need for emergency interventions.
Yeah, build a solid foundation.
Okay. But let's be real, in DeFi, things don't always go according to plan. What happens if, a borrower's collateral just tanks in value and their loan's at risk of liquidation? How does Lenfi handle that whole process?
So this is where their unique approach to liquidations comes in. It's not just about, punishing borrowers. It's about finding a solution that benefits both sides.
Okay, I'm intrigued. How do they make that a win-win?
So they use a system called a decentralized liquidation oracle,
Okay.
which is essentially a network of independent nodes that verify liquidation requests.
So it's not just one entity making that decision?
No, it's much more decentralized and transparent. And here's where it gets interesting. Anyone on the platform can actually participate in the liquidation process, meaning they can step in, repay the loan on behalf of the borrower,
Okay.
and receive a portion of the collateral as a reward.
So it's like a decentralized system of debt collectors, but with incentives to act fairly and efficiently.
Yeah, exactly. It's a really clever mechanism.
But what happens to the borrower in all of this?
So the borrower doesn't lose everything. After the liquidator takes their share, the remaining collateral is returned to the borrower.
Okay.
It's not ideal, obviously, but it's a way to mitigate their losses.
Right. So it's not just about, seizing all the assets. It's about finding a more balanced solution.
Exactly.
But we can't talk about Lenfi without diving deeper into the role of their native token, LENFI.
Right.
I mean, we touched upon its use in governance, but it seems like it has other utilities as well.
It does. It's designed to be kind of the heart of the Lenfi ecosystem. You can use it as collateral for loans, stake it to earn rewards, even use it to provide liquidity on decentralized exchanges.
So it's a real multi-purpose token.
Yeah, a workhorse.
But, one thing that always comes up with new tokens is transparency.
Right?
How do we know that Lenfi is being responsible with LNFI?
Well, they've actually gone above and beyond in terms of transparency.
Okay, how so?
They've publicly shared the wallet addresses that are holding the LNFI treasury and the tokens that are not yet in circulation.
Oh, wow.
And they're even moving towards a multi-sig address for the treasury, which requires multiple parties to approve any transactions.
So it's like checks and balances.
Yeah, exactly. Adding those extra layers of security and accountability.
That's a good sign for sure. But we've been talking about all these, features and technical details. I want to bring it back to our listener for a minute. How does all this translate into real world use cases? Who are the people who would actually benefit from using Lenfi?
So Lenfi is really designed to appeal to a wide range of users, both those who are, familiar with DeFi and those who are just kind of starting to dip their toes in.
Okay, so both the DeFi veterans and the newbies.
Exactly.
All right, so let's start with the lenders. What advantages does Lenfi offer them compared to, traditional lending methods or even other DeFi platforms?
Well, one of the key benefits is the potential for higher returns.
Okay.
By cutting out the middleman, Lenfi allows lenders to earn more interest on their crypto assets compared to, say, traditional savings accounts, or even some centralized lending platforms.
So it's about maximizing returns while still, maintaining that level of security and transparency we talked about.
Exactly. And with the added flexibility of NFT bonds, lenders can really tailor their lending strategies to their specific risk appetite and investment goals.
All right, sounds pretty compelling for lenders, but what about borrowers? What makes Lenfi a good choice for them?
So Lenfi offers borrowers a way to access liquidity without having to sell their crypto holdings.
Okay.
And this could be particularly useful for traders who want to leverage their positions, or anyone who believes in the long-term value of their assets but needs short-term access to funds.
So it's about providing that financial flexibility.
Yeah, exactly. While still holding on to your crypto.
Right.
And because Lenfi is built on Cardano, borrowers also benefit from lower transaction fees and faster processing times compared to some other DeFi platforms.
All right, so it's kind of a win-win for both sides.
Yeah, that's the idea.
All right. Well, Lenfi seems to have created a pretty compelling platform here. Lots of emphasis on security, transparency, innovation.
Yeah, it's definitely an interesting approach. They're trying to tackle some of those key challenges that have kind of held back DeFi adoption and make
Yeah.
it more accessible to a wider audience.
But we've only scratched the surface here. I mean, Lenfi has a lot more to offer, including some really innovative features that push the boundaries of what we typically see in DeFi. Let's explore those in more detail.
Absolutely. There's a lot more to uncover, particularly when it comes to their unique approach to liquidity pools and their use of NFTs to create these novel financial instruments. That's where things get really, really interesting.
I'm all ears. Okay, so we've talked a lot about Lenfi. You know how it works, what makes it unique, and all the potential benefits. But I feel like there's still more to uncover here,
Oh, yeah.
especially when it comes to like how they're really trying to push the boundaries of DeFi. What else should our listeners know about their innovative approach?
So there are a couple of areas where Lenfi is really going above and beyond. One is their whole approach to liquidity pools.
Hmm.
They're not just providing a place to park your assets and earn a little interest. It's like they're introducing these new ways to interact with those pools and even make them more liquid.
More liquid. Well, liquidity is always a good thing in DeFi. How are they achieving that?
So remember how we were talking about those NFT bonds and how they represent your share at a pool?
Yeah.
Well, Lenfi is taking that even further by exploring the use of NFT LP tokens.
NFTLP tokens.
Yeah.
So instead of just like having a balance in a pool, you'd have this unique NFT that represents your share.
Right.
What's the advantage of that?
Well, for one, it adds a layer of security and traceability
Okay.
because each NFT is, uniquely identifiable.
Right.
But more importantly, it opens up this possibility of actually trading those LP tokens on, NFT marketplaces.
Wait, so you could actually buy or sell your share of a liquidity pool
Yeah,
just like you would any other NFT.
exactly.
Wow, that's pretty groundbreaking in terms of liquidity. It's like turning your stake in a pool into this tradable asset.
Right. And because NFTs can store all this additional data,
Yeah.
those LP tokens could even contain information about the pool's performance, the underlying assets, and your share of the rewards.
So it's not just about ownership. It's about having a more like transparent and informative representation of your stake in that pool.
Exactly.
That's really cool, but it sounds like they're not stopping there with the NFTs. They mentioned something about like creating new financial instruments.
They are. Yeah, they're looking into this possibility of creating NFT-based derivatives.
Derivatives. Okay, now we're getting into some complex stuff here. How would that even work with NFTs?
So imagine an NFT that tracks the price of, say, Bitcoin.
Okay.
Holding that NFT would be like holding a digital version of a Bitcoin futures contract.
So you could basically gain exposure to an asset's price movements without actually owning the asset itself.
Yeah, exactly.
That sounds powerful, but also potentially risky.
Yeah, definitely. There are risks involved,
Mhm.
just like with any derivative. But Lenfi believes that by using NFTs, they can make these instruments more transparent and accessible.
More transparent. How so?
Well, because everything is recorded on the blockchain, anyone can view the terms of the the contract,
Right.
track its performance. It takes away a lot of that opacity that often surrounds, traditional derivatives markets.
Right, right. Okay, I'm starting to see the bigger picture here, how Lenfi is really trying to, innovate and push DeFi forward. But, with all this innovation, with all this, cutting edge stuff, there's got to be some risk involved.
You gotta be careful.
I mean, we can't ignore the fact that DeFi is still a relatively young space and it can be pretty volatile.
For sure.
So, what advice would you give to our listener who's, maybe considering dipping their toes into the Lenfi pool, so to speak?
Well, first and foremost, do your own research.
Mm, yeah.
Don't just take our word for it. Read through their documentation, explore the platform, get a feel for how everything
So
works.
due diligence is key.
Absolutely.
Don't just jump in blindly.
Oh, no. Okay. Good advice. What
Well,
else? And understand the risks involved.
yeah.
DeFi can be very rewarding,
Uh-huh.
but it's not without its dangers.
Right.
Be prepared for, volatility, potential smart contract bugs,
Yeah.
and the ever-present risk of scams, unfortunately.
So it's about, being informed, understanding the potential downsides as well as the upsides.
Exactly. And never invest more than you can afford to lose.
Right.
DeFi is still experimental in a lot of ways.
Mm-hmm.
And there's always that possibility of things going wrong.
Yeah. That's sound advice. But even with the risks, it seems like Lenfi is really trying to create a more secure, transparent, and user-friendly DeFi experience.
Yeah, I think that's fair to say. They're aiming high, and it's exciting to see platforms like Lenfi, really pushing the boundaries of what's possible in decentralized finance.
Well, I think we've given our listeners a really solid overview of Lenfi here, from the basics to some of the more cutting edge stuff.
Yeah, we covered a lot of ground.
It's definitely a platform worth keeping an eye on.
Absolutely. Lenfi is a great example of how DeFi is evolving and maturing.
Hmm.
It's not just about hype anymore. It's about building real solutions that can benefit a wide range of users.
I think that's a great note to end on. So if you're intrigued by what you've heard today, be sure to check out Lenfi's website, explore their platform.
Yeah, and as always,
And as always, do your own research
do your own research.
before making any financial decisions.
Right.
We'll be back soon with another deep dive into the world of decentralized finance. Until then, stay curious and stay informed.
Stay safe out there.